Welcome, everyone. So today we're going to dive into a really crucial and honestly an increasingly common area of taxation, how Canada's income tax system deals with non-residents. Now, whether you end up advising a foreign executive, an international musician, or just someone who owns a rental property here, you absolutely have to understand these rules. It's fundamental. So let's get right into it.
This material is designed to give you a clear, structured overview of the core principles. Think of this as the foundation you'll need to master before you can tackle more complex client files.
So let's kick things off with a pretty common scenario. Imagine your client is a software engineer living in Seattle, but they commute to their job in Vancouver. Or maybe they're an actor from France, here in Toronto for a 6-month film shoot. You know, these aren't just textbook examples. This is the reality of a globalized world. So the big question is, how exactly does Canada get its piece of the pie? How are they taxed? That's what we're here to figure out.
And here's our roadmap for today. First, we need to nail down the definition of a non-resident. It's not as simple as you might think. Then, we'll look at the two and only two paths Canada uses for taxation. We'll break down Method 1, the withholding tax, and Method 2, which involves filing a return. After that, we'll get into some more advanced stuff like special elections and property rules, and then we'll wrap it all up with the key takeaways you need to remember.
Okay, first things first. Before you can apply a single tax rule, you have to figure out the taxpayer's residency status. I can't stress this enough. Absolutely everything else flows from this one single determination.
So what does it mean to be a non-resident for tax purposes? Here's the most important point right here. It is not about your citizenship. It's not about what passport you hold. A Canadian citizen can absolutely be a non-resident for tax purposes, and a foreign citizen can be a full-blown resident. For the Canada Revenue Agency, the CRA, it all comes down to a single concept: your residential ties.
And the CRA helpfully breaks these ties into two big categories. On the left, you've got your significant residential ties. These are the heavy hitters, the big ones. We're talking about a home in Canada, a spouse or common law partner, or dependents, like children living in Canada. If you have even one of these, it points very strongly towards you being a resident. Then, on the right, we have secondary ties. You can think of these as supporting evidence, things like having Canadian bank accounts, a driver's license, a Canadian passport, or even memberships in Canadian clubs or organizations. The CRA looks at the whole picture, but trust me, those significant ties on the left carry the most weight.
Okay, so let's say we've done our analysis and we've determined our client is in fact a non-resident. Now what? How does Canada actually tax the money they earn here? This brings us to the core framework of today's entire lesson.
Canada uses what's called a dual-track system. I want you to picture a fork in the road. Depending on the type of income a non-resident earns from Canada, they're going to be sent down one of these two paths. Path number 1, Method 1, a very simple final withholding tax. Path number 2, Method 2, is the process we're all more familiar with: filing an actual tax return. Let's break each of these down.
We'll start with Method 1. This one is really designed for simplicity. The official name in the Income Tax Act is Part 13 tax, but pretty much everyone just calls it the non-resident withholding tax.
The default rate for this tax is a flat 25%. It's not a progressive rate that changes with income, it's just a straight 25% taken right off the top of the gross payment. And really importantly, it's the responsibility of the Canadian person or company making the payment to withhold that 25% and send it to the CRA. Now, a key side note here is that a tax treaty between Canada and the non-resident's home country can often reduce this rate significantly.
So what kind of income gets this treatment? Well, it's typically what we call passive income. Think of things like interest and dividends from Canadian investments, rental payments from a Canadian property, pension payments, RRSP withdrawals, and royalty payments. Basically, these are all situations where the non-resident isn't actively in Canada working to earn that money.
And here's the key concept for Method 1, finality. For these types of income, that 25% tax is the end of the story. It's their final tax obligation to Canada. The non-resident doesn't have to file a Canadian tax return for this income. The tax is paid and their duty to Canada is done. Simple as that.
But what about all the other kinds of income? Well, that brings us to our second path, Method 2. This is where the non-resident is required to file a Canadian income tax return, a process that looks a lot more like what a Canadian resident has to go through.
This method applies to what you can generally think of as active income. So if a non-resident performs work in Canada, either as an employee or by running their own business here, that income has to be reported on a return. The same goes for things like Canadian scholarships and, this is a big one, any taxable capital gains from selling certain types of Canadian property. We'll come back to that in more detail later.
And this right here is the biggest difference between the two methods. While Method 1 taxes the gross income, Method 2 taxes the net income. By filing a return, the non-resident gets to claim deductions and credits. So a consultant can deduct their business expenses. They're taxed on their profit, not their total revenue. And this often leads to a much lower tax bill and, quite possibly, a nice refund of any tax that was withheld at the source.
All right, now that we've got that two-method framework down, let's look at some really powerful exceptions and special rules. This is where we get into the advanced concepts that really separate the novices from the pros in tax practice.
The Income Tax Act has these things called elections, which are amazing. They basically allow a taxpayer to choose to go down Path 2 for income that would normally fall under Path 1. Just look at the Section 216 election for rental income. Normally, that income is subject to a 25% withholding tax on the gross rent, right? But if you make this election, the non-resident can file a special return and pay tax on their net rental profit, after deducting expenses like mortgage interest, property taxes, and condo fees. It's a game changer. The same idea applies to the Section 217 election for pension income. These are incredibly useful planning tools you need to know about.
Okay, another area that requires extreme caution is when a non-resident sells what the CRA calls taxable Canadian property. Now, this most often means real estate in Canada, but it can also include things like shares of certain private Canadian companies. It's a complex area.
The compliance process for selling property is incredibly strict and it's proactive. Before the sale is even finalized, the non-resident seller must notify the CRA of the sale and pay an estimated tax on the capital gain. It's only after they do this that the CRA will issue a certificate of compliance, and without that certificate, the buyer of the property is required by law to withhold a huge chunk of the purchase price and send it to the CRA. Then finally, the non-resident still has to file a Canadian tax return for that year to report the sale and figure out their final tax bill. It's a multi-step process and you can't skip any of it.
All right, I know we've covered a ton of ground today, so let's just pause and distill this all down to the absolute most important points that you need to take with you from this lecture. First, residency is always about ties, not your passport. Second, remember that two-path framework. Is it passive income subject to a withholding tax, or is it active income that needs a tax return? Everything falls into one of those two buckets. Third, know that these special elections, like 216 and 217, exist to give your clients flexibility and save them a lot of money. And finally, never ever forget the strict multi-step process for property sales. Missing a step here can be incredibly costly. And that brings us to our final thought for today. We have just established the foundation of Canada's domestic tax law for non-residents. But there's another higher layer of law that can come in and change everything we've just talked about, and that is an international tax treaty. A treaty can reduce withholding rates. For example, the Canada-US treaty often drops the tax on dividends from 25% to 15%. It can even exempt certain types of income from Canadian tax entirely. That is the next level of complexity, and that is exactly where we will pick things up in our next session. Thank you.